Hello there. Welcome to Investing 101, Lesson 7, ETFs.
When someone says hi, it's usually polite to say hi back.
In the last lesson, we talked about index funds and mutual funds and how they're really good ways to get a diversified portfolio. In this lesson, we're going to talk about a cousin of the index fund, the Exchange Traded Fund, or ETF. An ETF is essentially the same thing as an index fund, except that it's traded on a stock exchange and it has a ticker just like a stock, which means that you can buy and sell ETFs using any brokerage firm. There are thousands of ETFs available, and they can own US stocks, international stocks, bonds, and even REITs. Some, though, are very, very specific. For example, an ETF might focus just on Brazil, owning stocks only from that country, whereas others will focus on a specific industry, like gold mining. For the most part, though, you should focus on ETFs that cover a broad swath of the market. There are many websites out there that will give you detailed information as well as ratings on individual ETFs, such as Morningstar.com and ETF.com.
Data, I cannot make bricks without clay.
Let's take a look at how to do some basic research on ETFs at ETF.com. Once you've loaded the main page, you can either search for a specific ETF, or you can scroll over ETF tools and data, and then click on ETF Screener and Database. On this page, scroll down, and you'll find a list of the 10 largest ETFs, sorted by assets under management. This shows you a brief overview of each ETF, including the market segment it covers, as well as its expense ratio. As you can see, many of these big ETFs cover large cap stocks, which means that they are comprised of stocks from large companies. Other popular segments include Developed Markets ex-United States, which cover stocks from developed countries outside of the United States, such as Japan and European countries. Emerging market ETFs have stocks from emerging countries like China and India, as well as countries in Africa and South America. You can also find fixed income bond ETFs, such as AGG. You can get a lot more detailed information by clicking on the ticker for each ETF. Let's take a closer look at VTI, the Vanguard Total Stock Market ETF. On this page, you can find a brief overview and methodology for the ETF, as well as other important information, such as the fund's expense ratio and total assets under management. One great thing about ETF.com is that you can scroll over a lot of this data and it will explain to you exactly what that data is. Farther down, you can also find the fund's distribution yield, which will tell you roughly how much money you'll get in dividends each year. You can also see here that VTI holds over 3,000 different stocks in its portfolio. So you can see that VTI is an extremely diversified investment. The differences between ETFs and index funds can boil down to three main areas: liquidity, fees, and taxes.
All too easy.
Since ETFs are bought and sold on stock exchanges, that means they're generally more liquid than index funds. There's no minimum investment. You can buy 1,000 shares or you can buy just one share of an ETF. And you can buy it from any broker. The rules governing the buying and selling of index funds are much more varied, because each broker will have different rules for its own funds. Some index funds have a minimum purchase of $2,500 or more, so that makes them less liquid than ETFs. Although, for a lot of index funds, you can buy fractional shares, which is something that you can't do with an exchange-traded fund. In addition, some index funds require you to give notice before you sell your shares, and they can't be traded intraday, which means that all sales are completed after the trading day is over. So, ETFs are generally more liquid than index funds, but this isn't always a good thing, because investors might be more tempted to buy and sell their ETFs a lot more than they would be their index funds. Index funds and ETFs also charge you fees in different ways. For an ETF, you'll generally have to pay an upfront brokerage commission when you buy the ETF. It's usually the same rate that you would pay when you buy stock. Index funds, on the other hand, generally don't charge a sales commission or front-end load. However, there are an increasing number of ways to get commission-free ETFs. For example, if you have an account at Charles Schwab, they will waive their sales commission if you buy their own branded ETFs. And E-Trade has a long list of commission-free ETFs, from companies such as Vanguard and BlackRock. Finally, ETFs are generally more tax efficient. Because investors are constantly buying and selling their index funds, the fund manager has to constantly rebalance the portfolio. All this buying and selling creates a lot of taxable events, because every time there's a capital gain from one of their sales, the government comes in and takes a cut.
I tell you, Uncle Sam.
Because ETFs are traded on the open market, investors aren't exposed to nearly as many capital gains, which results in a lighter tax bill. ETFs are a great option for investors, but it's important to do your due diligence before making a purchase. Look for ETFs with high ratings, low expense ratios, and a lot of assets under management. In the next lesson, we're going to look at the tax implications of your investments, including the advantages of 401ks and IRAs.